here's the one thing I'll tell you. If you're looking for the next stocks that are going to give you those US big cap tech-like returns that we've seen over the last 15 years, I'm just going to tell you right now, you're not going to find it in the S&P 500.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I'm joined as always by the brain trust himself, Mr. Chase Taylor. A little bit of bloodletting on the street today.
Yeah, I saw we were in extreme fear mode, which cracks me up because
trading at 32 times earnings,
2% drawdown, extreme fear. Like, what would everyone just jump off buildings if we were down 4%? Like, I don't understand.
Yeah, you don't want to get over technical about that because there's sentiment readings. I honestly, I have watched those things get more and more ridiculous over the years. And I think that so many of those metrics that you've used because of the unprecedented retail involvement in this market, I just think that so many of those things are just useless. You know what I mean?
That one clearly is.
Yeah.
It's probably the CNN fear and greed one or whatever, but that seems a little nutty.
And then today just kind of like, I mean, pretty much there was nowhere to hide. It was like somebody just hit the sell button.
Yeah. And
the dollar up.
To that point, so often when we've had these sell-offs in tech, you almost always get like a weird reflexive bounce in equal weight or small caps. And today, small caps were down 1.7. Equal weight was better than the S&P, but like it's still down, close to 0.7. So you didn't even get a little bit of relief from anything like that. Not energy, like nothing was there for you.
Yeah, and this is why I can't. I mean, nothing has changed. I mean, we're where we were a month ago. It's crazy. Sure. Fundamentals are detached. All the things we know. And this is just 100% anecdotal. I just don't like it, man. I told you earlier this morning, right before our when we were texting shortly after the market opened, I was just like, honestly, and I don't want to do it right now because of the things we hold. I just think that, I think that, like you and I have talked about, like, obviously we want to manage risk, but I think the biggest mistake that we can make is getting shaken out of a lot of the stuff we own because we own it at generationally cheap prices and we just can't. That being said, I just look at this market. And if you gave me a choice right now, if I had the ability to, without generating any cap gains and anything like, if I could just sit on the sidelines right now for the next 2 to 3 weeks in cash, that feels. Now, I'm not advising anybody do that. Part of the reason that I feel that way is because we've had, double-digit outperformance on the indexes this year.
Yeah, today would have been a nice day to be all cash.
Yeah, just a phenomenal day. Yeah, I just don't like this. I just don't like this market. I feel like there's a bunch of, it could just be short-term overbought and need to get it just like we were talking about this morning. There's just been so many of these jump the shark things, Carp going after the short seller for Palantir. Like I'm sitting there going, why? They have 2% short interest, 2%.
Right. Like, what are we even talking about?
Trading at 120 times revenue.
Oh, by the way, apparently Michael Burry is short a lot of Palantir.
Yeah, but
if I had a dollar for every time Michael Burry was short something.
Well, yeah, but also the other side of it too is it makes it sound like it's this huge position. Journalists of all ilk are just trash. I mean, I don't think journalism has ever been worse than it is now. It is especially bad in financial media. They always cite the notional value, right? Like, so in reality, he probably has 3 to 4% of his portfolio in puts on Palantir, but they're citing the notional value.
Yeah, I didn't even see what was. Yeah, it is puts covering 5 million shares. So there you go.
Yeah, so he's probably got 4 to 5% of his portfolio in that position.
And that could be a hedge to other things he has for all we know. So
yeah, I mean, I didn't realize that, but we went short Palantir today.
Right.
And there was a funny.
It is very notable that they had a good quarter and a good guidance and fell. Like that's just, especially on the heels of everything else we're talking about here. It's just.
Well, this is also a classic example of the math problem that we're talking about. Okay, so if you're long Palantir, right, and you think, let's say you think that revenue is going to double in the next 12 months. Okay, so you're running at a run rate of about $4.5 billion right now. Okay, you think revenue a year from now is going to be $9 billion, right? And your hope for that is that it drives the stock up 50%, maybe?
Sure.
Okay, so the problem is that, now remember, we're talking about, could a doubling of the revenue equate to a 50% gain in the stock? If you're scoring at home and you think a doubling of revenue should equate to more than 50% gain in the stock, I would agree with you, right? But this is what you call handicapping. So by saying a 50% gain in the stock, I'm actually trying to paint a very favorable picture for Palantir to illustrate how insanely overpriced this is. So if you get that bump and revenue goes from 4.5 to 9 billion, and it equates to a 50% gain in the stock, and if you're long Palantir here, I would have to think that you would expect a 50% gain in the stock on a doubling of revenue in the next 12 months, or why the hell else would you be long?
My assumption is people would expect 100%, not 50, but.
Okay, so I agree with you, but let's just use the 50. So now you want a stock to add $250 billion in market cap because they increased revenue by $4.5 billion. Think about what you're asking for. And then sit there and start doing that arithmetic and start playing with those numbers and ask yourself, what needs to happen to this stock in order to make meaningful gains from here?
Arithmetic is not necessary nor sufficient for Palantir shareholders, Tesla shareholders. Like, they don't.
No, they don't.
They don't care.
And
some stocks are just dream catchers, man. They have nothing to do with reality.
Yeah, no. And that's, to me, I think Palantir is even a more odd case than Tesla, because Tesla has this thing in its back pocket called Elon Musk, and the guy's pulled some crazy stuff off, like we've talked about. Also, now they got plenty obscenely priced, but even Tesla didn't get to 120 times revenue. I mean, I've just never seen anything this expensive. Like, maybe in penny stock world or something like that.
Some like tiny thing that's a wild growth rate, fine. But yeah,
I just look at it. I love the company, man. I think Palantir's awesome. I love the products. Like, we've been long before. We've made money on the stock. Nothing against it. But I don't even know, how do you handicap that? I don't even know what the investment thesis would be.
There isn't one.
Yeah,
it's just not.
No, how can there be?
Yeah.
A $4.5 billion of revenue on a $500 billion. I mean, that sounds like a joke. You know what I mean?
Yeah. It
sounds like a punchline.
I saw a great quote today from Barton Biggs that I said, there's no asset class that too much money cannot spoil. Just there you go.
100%. And I just, the other side of it too is just, here's the other thing that I think investors need to be aware of. Okay, guys, here's the one thing I'll tell you. If you're looking for the next stocks that are going to give you those US big cap tech-like returns that we've seen over the last 15 years, I'm just going to tell you right now, you're not going to find it in the S&P 500. Not right now.
Yeah, I mean, I totally agree. Of course, but
yeah, I'm just like, think about what you're asking for. Like, your investment thesis is that multiples are going to go to 60 times earnings. And
the average person is not getting out the Asian, they go and looking at Asian mid caps or something. No one's doing that. No. But that's where the stuff's at. That's where you want to find stuff. That's where the growth is. That's where the competitiveness is for the future. Like, this stuff has a better future and it trades at a discount. Like, every once in a while, I guess in this job, like, you're going to have opportunities this good. Like, it's a great time to be doing this.
You know, what's funny is I was thinking about that the other day, and I mean this seriously. It is entirely possible that when you think about the historic makeup of this stock market right now, truly, we've never had a market that looks like this on so many different levels. You can point out so many different things that have never occurred before, right? I think it is probably likely that at least on a relative basis, we may never see as broad and as inviting of a buying opportunity as you see represented by ex-US versus US equities right now. We may never see.
Yeah, I think this is as good as it gets. I think this would have been like, doing the opposite around the Asian financial crisis. It's easy to forget, but back then everyone wanted Asia, not America.
Yep.
And all the money was there. That was a great opportunity to kind of do the opposite of what we have now. And everyone, that sounds crazy now because everyone knows you should have all your money in America, and because that's where all the everything is. The American asset exceptionalism. And the crazy thing is, like, the same thing that drove that reversal is, in my opinion, going to drive this reversal. It's all really simple. Like, but I think you're right. I think, for us, we're in our 40s. Like, this is the last great, massive secular shift in capital flows that you can just get ahead of, that will probably have the opportunity to partake in like this.
Mm-hmm. It could also be, and I'm not a doomsdayer or anything like that, but it could also be the last period of significant outperformance you see from U.S. equities for quite a while.
I think so, but me, like I have significant concerns about U.S. competitiveness moving forward. I think we have a lot of people in America that are like, well, we've been awesome in the past, so we're going to be awesome in the future. And I kind of view this the same way I view investing, where like I like to use the phrase that I stole from James Aitken of I don't have 25 years of experience. I have 1 year of experience 25 times. I view some of this stuff the same way. Like, America has done awesome stuff in the past, and we treat that like we did that. No. Like, they did that. Those people did that. Yeah. Those people that worked really hard and studied hard, put in the work. Like, we had more effective government leaders. We had more effective corporate leaders. Like, just everything was different. Like, they did that. You didn't do that.
Yeah.
So, like, you can't pretend like you can just pick up the ball where they left it off. Like, no, like, basically you can boil it all down to human capital. Like, when I look at human capital, I just read this in a book last night, that if you ask like American high school students, first of all, if you score them in math, it's not good versus the rest of the world. But if you ask them how confident they are in their abilities in math,
they feel great.
Number one in the world.
There you go.
So not only are we not good at stuff, we're so sure that we're great at it. And that's not that plus policy, it's just not, we're not headed into a competitive place.
No, and it's not. I mean, like, I hate to use this term because it's really been bastardized, but that right there is not the definition of American exceptionalism. You know what I mean? American exceptionalism was, we're number one, but we're terrified that we're going to fall to 25 or 30. And so we're grinding harder and working harder. And you know what I mean? And now, like you said, it's the inverse. And we're at a crossroads, like we've in so many different ways in the country. I mean, look at the support you have of basically like self-professed communists leading mayoral races, right? Like, America is at a crossroads.
But like, I can't even really identify a prominent capitalist anymore that's like actually believes in market forces anymore. Like, the GOP's throwing in the towel on that. I do. Right? I do. I hear you, but like, the party you're forced to vote for at most elections has abandoned that. Yeah. No.
Well, look. I mean, this was this was my biggest concern and my biggest problem with so many of the actions of the federal government and the Federal Reserve over the last 15 years. We had our investment call this morning, and I said something that I very much believe in, which is somebody. One of the analysts made a comment about, what about this risk or that risk or whatever, and I go, who gives a crap about that risk? They're going to bail it out. Like, and what I'm saying is, this is the whole pernicious problem of when you start playing with capitalism and free markets the way that we have over the last 15 years, you reach a certain problem where you can't justify not doing anything, right? Because you've done it so many times before. You've intervened so many times before. And like I've said, every time you intervene, you're altering the trajectory of that market, right? And it's always to the upper side. So what I mean by that is every time you intervene, not only do you save the market, but you build the scaffolding another layer higher.
It's a ratcheting effect. Yep.
Yeah, it's a ratcheting effect. And what that means is when it eventually falls, it's going to fall harder. But what that also means is because of that threat, every time you intervene, you're more compelled to intervene the next time. You have to. Right? Because you can't be the one that got it up to this, precarious place. And then all of a sudden, when the S&P is trading at 55 times earnings, you're like, well, we got to let markets work this out. You know what I mean? You can't do that.
Yeah.
And so, and for people that are calling out hypocrisy on the right, I think that they're 100% correct.
Yeah. And don't get me wrong. Like,
I don't think we have a choice though.
Right. I was saying, I'm a markets guy, but I understand that we have reached some stresses in certain areas where, like, I think industrial policy is called for in certain ways. And I'm not saying that everything should be all laissez-faire, like just let the markets figure it out. Cause I think that leads to a bad place. But point being, there was a time where the tie went to the market more often than not. And I would say we've reached a point policy-wise, both parties, where the tide never goes to the market ever. Like, no one cares.
Well, we don't like what the market has to say.
Yeah.
And,
right.
And more importantly, the other thing that I think is an issue is the market itself, meaning a big part, and I don't think anybody thought about this, but a big part of quote unquote American exceptionalism, especially Americans' dominance of the economy for the last, since post-World War II, a lot of that was our markets, meaning the deepest markets, the most liquid markets, the best regulated markets, all that kind of stuff. Well, remember, to have the best markets, the core function of that market must be in place, must be functional, and must be efficacious, right? And the core function of any market is to be a price discovery mechanism. The other thing is you're able to look around this market increasingly on a day-to-day aspect and go start comparing securities. And you just realize that in certain cases it works, in a lot of cases it doesn't. Like you're looking, it's just completely ununiformed. Right. The results you saw, and again, I actually like both companies, but compare the reports and the valuations and everything of Sprout Farmers Market versus Wingstop, and then look at the reaction of their stocks. I mean, there's so many other we could point out, but they're right there as an emblem of markets are supposed to be consistent, right? Like that's part of a pricing mechanism is they're supposed to be dynamic, but they're supposed to be consistent, right? To a certain degree, there should be uniformity, right? There's just not at all. There's not at all. I mean, and you can play this game backward where you're looking at the two stocks and going, I'll give you the earnings releases. You tell me what happens on either one. And honestly, I think most people would miss. I mean, I know I certainly would.
Speaking of that, if you'd given me Palantir's results, I would have said stock up 10, maybe 15%. So like, it's just weird to hit these inflection points where like what you think is going to happen goes the other way. Should I rip through markets? We haven't done that yet.
Yeah. Hit them.
S&P was up, or sorry, that's how you know where we're at. S&P was down 1.17. Q is down 2. Small caps 1.7. Equal weight 0.66. Mag 7 down 2.3 and down a little bit after hours. All world ex-US down 1.3 thanks to the dollar being up another 0.3. Oil down a little bit. Gas up a little bit. Gold down 1.7, silver down almost 2.5. Basically all metals down. Copper down 2.7. Rates were down 2-3 basis points across the curve. And importantly to me today, Oracle down another 4%, Meta down another almost 2%. You had Tesla down 5, Nvidia down 4. But those important ones to me is watching Oracle, Meta, and obviously just another red day there. You had Vol up 4% on the day. There's
something you got to watch out for, and we could be 100% off, or I could be 100% off, as always. But when you're in a bubbly environment, and we don't need to get into the semantics about whether it's bubble, whether it's not, blah, I think it's a silly argument to have. I think there are most things I think are bubbly. They're not tied to fundamentals. There are some that aren't. I think to try to throw a blanket over the whole thing is silly. Now I lost track of what I was going to say.
These things happen.
Yeah, no. But there is something different going on here, or at least it has that feel. And what I was going to say, I remember, is that trying to pick the tops and bottoms of markets like this is a fool's errand.
No doubt.
Having said that, there are usually hallmarks. There are these moments. And what concerns me about this market right now, obviously the fundamentals, valuation, all the stuff that we know, but what you just said about Oracle and Meta and how close that has happened to this orgy of these Ponzi-like finance deals that everybody has announced. These are types of things, and I'm not calling a top. I'm just saying these are types of things, right, that you see at tops, right? These jump the shark moments.
Yeah, and to build on that, I've talked about this a little bit in the last week, but these special purpose vehicles that are getting used for off balance sheet debt, there's something about creative financing that tends to mark, big spots. So who else used, these kinds of creative financing vehicles in the past? Well, Enron's one of them. Like, if you want to take on a bunch of debt, lever up without people realizing it, you put it in a special purpose vehicle where it doesn't show up on your balance sheet. I would love to see some reform on that, to where you have to find a way to make it show on your balance sheet, but instead of in the footnotes, right? But that's at the same time, as an investor, there's a part of me that wants to be able to look at the footnotes and realize what the market's asleep to. But, and so you go back .com bubble and prior bubbles, like there's usually some SPV activity that picks up into the latter innings of that stuff. Like
the other thing that you always see universally at the tops of these bubble cycles is, like you said, the creative financing, but to elaborate on that a little bit, you always see like you said, the financing get to weird places to just keep the ball rolling. You see these Ponzi-like finance deals.
Yeah. I mean, we have these guys essentially buying their own supply and subsidizing their own sales and stuff through the way that we're doing this. And
then the market is rewarding those investments in that CapEx as if it's earnings. Like I was saying yesterday, right. Google announces a $30 billion debt offering and their stock goes up 1% or $30 billion, right? So the market they're taking on $30 billion of debt and the market is treating that as if it's an asset, and their enterprise value goes up by 60 billion.
Yeah. And we've had like 100 billion in AI debt issued in like the last month. Like, that's a lot of money.
Wow, multiples expanded in the sector.
Yeah. And that's just the on balance sheet stuff. Like, forget the off balance sheet stuff that's very, very present as well. Like I don't understand. I do not understand the way the regulatory environment works. And I don't understand, we've had these questions. I don't understand why they allow them to do that SPV action. I don't understand why they allow them to record stock compensation the way they do. I do not understand why they allow them to use their own earnings metrics and earnings releases. I don't understand all of it. And, right.
and if the goal is, a reduction of opacity, if the goal is transparency in the markets, I'm just looking at those rules going, it's sort of like the carried interest loophole. Like, why is that? What are we doing? It's another one. I mean, have you read like this is changing it, but have you read some of the stock trades recently that have happened, like with members of Congress, like buying individual stocks, and a week and a half later, a deal getting announced with the federal government and they make 200% on the stock and all that kind of, there's just so much of this stuff where you're going, why are we allowing these things? What are we doing? Yeah.
To go back to being not competitive, right? Like, if you want to ruin it, it's the kind of stuff that happens to ruin it all.
Yeah. And for what? For another 10 to 15% run on the indexes? It just doesn't. Yeah.
And to go back to what we talked about offline yesterday with like the financial nihilism. And I made the point, like, what scares me is that financial nihilism is working. Like, what does like the social fabric look like if it stops working? But the crazy thing is, like, freaking senators are also financial nihilists, right? Like they're also trying to get all, like, it's like hungry hippos. Like, this is like a medieval kingdom, and this is like the last time we plunder somebody. We better get ours, you know, because there's no more plunderers to come. Like, there's like a weird scarcity mindset.
It has that feel
in an age where we don't have much scarcity. It's just, the whole thing's weird, but
it is. It's unnerving.
Well, I shouldn't say we don't have scarcity. A lot of people do have scarcity. You know, the K-shaped thing's so pronounced and real, but
it's so true.
Yeah.
And I don't think that there's ever been more like societal desperation to economically climb, you know?
Yeah. I feel like anyone in a big city in America, like at any moment you might be sitting in a car looking out the window at someone trying to find food to eat while also looking at your Instagram feed of someone bragging about being on a private jet. Like, it's just it's a weird environment. Everyone gets to see both of those things daily.
Yeah, which is not
both sides of the K.
Which is not culturally good.
It's not.
It's like a time bomb.
Society.
No, it's not at all. And that schism leads to greater schisms and conflict and all that other kind of stuff. And like you point out, man, you know, a 40% drop in the S&P would not do anything to quell those fears.
Right.
And people get wiped out because so many of these retail people are levered to the hilt. The other thing is, if you have the S&P down 35 to 40, what is a lot of the stuff these people are invested in at? Yeah.
We had that happen. I'm glad you brought that up. Like, if you remember back in April, you had that happen where, you know, the market was down like 20 or whatever. But then the average like retail person was down like 50, 60 because they have super high beta trash in their portfolio. And the worst thing that can happen, so far we haven't really had to deal with this in the last, 5 years, 3 years, whatever, is the worst thing you have happen is when retail sells into the hole, right? And we haven't had that. We haven't had it stay long enough or go deep enough for people to freak out and capitulate and just be like, I just want my $20 so I can at least get...
You really haven't.
At least get one more meal out of this thing. Like, people just keep buying. Or they hold because they know it's going to come back. And so, you know, to this point, it always comes back for them. But if you ever get to that point where it's bad enough to where people like do, you know, cry uncle and sell into the hole, that's when the realized losses become, that just becomes a huge problem.
Well, if and when that happens, because it's not really an if. I mean, eventually it has to happen.
Right.
But
that
I mean,
may be forever from now. Right.
But when you look at the, you know, it kind of reminds me of a physics problem, right? Like one of the things that you can do is, you know, you can judge future events like, you know, volcano eruptions or earthquakes. And it's not a perfect science, obviously, but you can kind of like judge the severity based by or based on, you know, the unspent energy or the pent up energy there, right? When you look at the pent up energy, especially in this market, and then, you know, look at ETFs, you look at all that kind of stuff. When that scenario happens, I think it's highly likely you're going to see at least one or more circuit breakers get tripped in a day, just because when you flip the reverse button on that ETF and everybody starts selling, it's so big, right? Like there aren't enough, you know, it's sort of like there aren't enough marginal buyers to come in here and knock the price of something down. When this flips, it's going to be the exact opposite. It doesn't even matter what the valuations will be. There won't be enough marginal buyers to come in there and stem the tide.
Right. And I think one of my big concerns, and I hate to be all doomerish on this one, but on this whole show, but like, is obviously we have these two mega forces of passive inflows. And Mike Green had a recent piece on that. It was awesome, where he basically tried to like attribute how much of some of these market caps are probably just that. It's really interesting. And the answer, to spoiler alert, is a lot of it.
Yeah, I would think so.
But if you take that and the capital flows, the money coming from overseas and into the US, those have both been just, I mean, tectonic forces on our market. And one of the two becoming an outflow is just a huge problem for relative performance of US assets at some point in the future. One of my fears is that we very, very unfortunately get both at the same time. That would be, you know, a cataclysm. Now, obviously, the authorities will find a way to, I'm sure to prop some stuff up. Capital controls probably being sadly the way that some of it goes, but like, I hope we at least get one of those at a time,
Yeah. The other thing that, and again, we'll have to see the way it plays out.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
The other part of that is concerning, like you talked about, is it's always in those moments where everybody becomes fundamentally aware, right? And that's the other issue you got, is even if the regulators or even if, the powers that be step in and try to stem the tide, in the past, what you've seen is their ability to calm markets, and then everything kind of calms down, and then the selling resumes. And if there's without question, I don't think the average investor is aware of how many air pockets there are in this market. I mean, there's so many of these companies that when you look at the multiples and the levels they're trading at, their own projections and guidance don't even measure up to it.
Yeah, and honestly, even if the companies do great and kill it and perform, I mean, at some point, they're Mag 7's 54% of GDP. It just, if the rest of the world just wants some of their money back, I don't care how good the earnings are at Microsoft. It isn't going to matter.
No,
and this happened. I really think the Asian financial crisis is worth studying from this point. Was like those markets were booming, and everyone told themselves stories about why, as you do. The reality was mostly just capital inflows. So it was it. It's just the money came in and it bid it up. So it made everything look awesome. And then when the money decided to leave, it didn't. Some of these companies are still doing good.
Yeah,
like, it's just, but it didn't matter because the whale decided to go home. Like,
I
think a lot of Americans don't view it as like, oh, that doesn't apply to us. But it does. Like,
and it has.
Trillions of dollars leaving would matter.
We've seen it. Look, from 2002 to 2012, Microsoft stock went nowhere while their revenue tripled. Their revenue tripled in a decade.
Right. I think we're going to come back to that.
Yeah. I don't see how you don't. I mean, again, it's just like at the end of the day, you can bid stock prices up all you want. Okay. But the reality is that valuations aren't important because you and I woke up and said they were. They're important because when you buy a corporation, and this is what everybody forgets about the stock market. When you buy a corporation, you don't profit until the returns that you have received exceed the original investment. That's how investing works, right? Stock market works a little bit different because you can get the immediate benefit of the shares rising. But at the end of the day, it doesn't change that game, right? That what drives your returns are cash flows. And when you are paying those prices for growth, it just doesn't pencil. It just doesn't. And it will return to a price that makes sense on an arithmetic basis. It has to. It's a financial asset, right? It will eventually be priced at a level that reflects interest rates, discount rates, things like that. It will have to. You don't need an economic cataclysm for this market to drop 40 or 50%. A return to 20 times earnings is a 40% drop in the S&P 500. So now the funny thing is you could have a mild hit to earnings and you could see a 40% pullback in stocks and you could be trading at 25 times earnings. I mean, I don't think people, have appreciation of just how stretched this stuff is and how even great companies that aren't absurdly priced like Palantir could easily shave 40 to 50% off their market cap and still be trading at the high end of their historical average.
I mean, in the .com bubble, we lost 40% of earnings, 40% of S&P market cap, or it was like 80% of NASDAQ market cap.
Yep.
Like growth barely got touched. One of the things that's concerning to me is like that was a very, very mild recession, right?
Barely a recession, and technically.
Is now like we've all collectively levered our personal balance sheets up to the market. So this time, if we get something similar, if the AI thing, the tide goes out on that, or just the tide on capital goes out, we don't have the luxury of being like, oh man, that was a bummer of a negative 1%, quarter in GDP. It'll be like oh man, this is a really ugly recession because we all stopped spending money because we all lost money.
Yeah.
I hate how much we have tied our fate to the equity market as a an economy. Like it's one of those deals where like the Fed, I think for 15 years just we just ignored financial stability risks. Like, and by that I mean asset price bubbles becoming a threat to real life economics, right?
Mm-hmm. Yeah, it'll be really interesting with time. It already has been, to look back at the changes that have occurred in our markets and our economy since 0809, since central banks becoming household names. You know what I mean? Like
since legislation mandated we all throw all of our money in the market.
Yep. And I think it's going to be really interesting to look back at the long-term effects that had. I think it's going to be really interesting to look at the long-term cultural effects that has had, because it has undoubtedly shaped these markets and shaped this culture a lot more than I think most people are aware. And it's a frightening thought to throw a recession and a serious equity market pullback into the current cultural mix that you're looking at in society right now. I don't. Right. I don't think
the financial nihilists made money.
Yeah.
If they stop.
Well,
and if they don't have a job, like.
Yeah, it's not a new tale, right? Like, what's the easiest way to keep a culture from ripping itself apart? Make sure everybody has something to lose. And when people don't have something to lose, that's when scary stuff happens. Yeah. But yeah, I just did something. It's not a prediction. I just have a nagging feeling that we're going to look back and be like, hey guys, when they started the Ponzi-like finance deals and the market was treating CapEx debt like it was profit, that was your sign to exit stage left. We've seen a lot of goofy stuff in the cycle. What's happened here in the last month, that's literally is making me go, oh, right. Oh.
I've talked about it every day since. I think the potential for it to be the huge deal. It really, like, Meta getting punished. Finally someone getting hit for the spending. That may not mark the top. That may mark the year of the top or something, or the 2-year span of the top. But that's a big deal.
And here's the crazy thing about it. I think in light of what Meta is doing, I feel like it's been a pretty measured market response. Like, I don't think that they're being overly penalized. I'm looking at the hit they're taking on their equity, and anybody that is spending at these levels, they should see multiple contraction. It doesn't make sense not to. Right? Like we were talking about yesterday. Bottom line is you're entering uncertainty. Uncertainty does not expand multiples. It compresses them. Yeah. And again, none of these things are hard, fast rules. It's not like somebody stops the market and is like, hey guys, this CapEx is uncertainty. Push their stock prices down. I'm not saying that. But just when you see rules of finance being completely flipped on their ears and everybody looking around happy, like, what's the problem? You're like, uh-oh.
You should at least take it seriously whenever the market looks like it is beginning to ask questions. And right now it looks like the market's asking questions. Like at Oracle, remember Oracle blasted off on that earnings report because they reported hundreds of millions of dollars or billions, whatever it was, of future revenue, which was mostly OpenAI revenue. Never mind the fact that OpenAI has no money, but the assumption is they'll go raise money in the Valley and then they'll hand it to Oracle. Never mind the fact that Oracle is paying for it all with a bunch of CapEx off their balance sheet. But now the market has realized that. And now Oracle's below that blast off level. Yeah. So the market is sobering up and asking these questions to AI CapEx at least.
Yeah. And again, the reason why you've got to pay attention to those things is I think it's a really good comp, right? The apex of these bubbles are almost always typically marked by the broader market believing something that on its face is ridiculous. Yeah. Right. So in 99, 2000, the new metric was not earnings or revenue growth. It was eyeballs. Right. And everybody accepted that. Right. And that's how we started rating stocks. Think how stupid that is.
Right.
Right. I mean, I'm not going to say anything, but I mean, if we value companies based on that, think of the horrific websites that have been put up for really disgusting purposes or whatever. And think of how many people went and looked at those almost on a dare basis, right? So they got all these eyeballs, 8 billion views or whatever. So now this worthless company is going to have a $400 billion market cap. I mean, and to me, the reason I bring that example up is when I see the markets treating previously even conceived amounts of CapEx like that, as if it's immediately accretive, as if it's profit. That to me, that rhymes so much with we're looking at eyeballs, where you're just sitting there, you look back on it, and it's one of those, you always look for those things, right? Where with some historic space and distance between you, you look back and go, that's the dumbest thing in the world. But yet at the time, you're like,
you're an idiot if you thought it was dumb.
Right. Those are always those things that market. And I when I'm watching those market caps go up because they're taking on debt, it just feels like that. It feels like that exact same thing to me.
Right. And I talked about these future signposts, one being people struggle to raise money. Because right now, like, no one's even coming close to struggling to raise money. It's just, they're starting to take a hit for doing too much CapEx, but they can still raise all the money they want.
It's starting to sound like it a little bit.
That next signpost is going to be a big one, but the other one is going to be like these order books. And Chanos made this point. It was basically like, if you go back to .com bubble, like when it finally let go was when people stopped double, triple ordering, all the, whatever it was, routers and fiber and whatever the equipment, right? Because they would over order on purpose because they're afraid that if they didn't, they couldn't get it.
Right.
And obviously we're seeing that now with chips and data center, anything. So if you start seeing any of that slow down, and we have in the past, like we talked about this morning, like Microsoft started backing away a little bit a few months ago, but then they jumped right back in. They're like, oh, just kidding. We want all those data centers, right? So like,
what was that about, by the way? That was such a weird, crazy Ivan because those were not small announcements. And I think that they made that initial announcement and then recanted. It was like a 2-week turnaround.
It's a FOMO thing, like I think they probably thought like, this is getting a little expensive. This is getting a little crazy.
Then their stock got hit.
But then, yeah, like you hear people talking about like being on the cusp of super intelligence, what it's going to mean. Like you can't help but be like, oh man, we can't miss that. So seeing these order books stall on almost any level is going to be huge. That along with if anyone struggles to raise money. And then obviously more and more of people getting punished for the spending. Yeah. And for all we know, like Meta makes a new high next week and this is all over for a year. But I do believe this. I do. And I'll still stick to my knitting on this one. If that happens, if we take off and bounce hard from here, I've repeated, I think it's the beginning of the end. I just don't think that I would probably buy. It's too unstable. Probably buy a new long-term put on Meta every day. It made a new high.
It's just the market's. We haven't even talked about breadth. I just think this market is getting too vulnerable. And when I see the reasons, like you said, when I see the reasons these things are selling off, when I see Palantir sell off on an otherwise great. Now, here's another. I saw so many. Oh, this market's so stupid. Why would it sell off Palantir? Because guys, it isn't enough for them to beat. Like, again, this is a math problem. You're talking about a company that's doing $4.5 billion of revenue with a $500 billion market cap. Well, why? I mean, anything can make that thing go down.
Yeah.
And at a certain point, and it was kind of like our argument at Tesla, why we shorted Tesla. Now, thankfully we got out of the way because it read back and I didn't think it would. But you just reach these points in the stock where you go, okay, Palantir's not going to announce most likely isn't going to announce anything better over the next month than they just did. Stock's getting hit for 9% today post earnings.
And to me, with that valuation, if the snack machine runs out of snacks in the Palantir break room, it should go down. Like,
yeah, right. You don't need anything, right? Like if an employee can't find a parking spot within 5 minutes at their headquarters, they should get a hit to their stock. So, yeah, and then the other side of it too is, look, if this stuff blasts off again, it's going to be hell watching it happen and not participate. I just think that now's the time where you just have to ignore that stuff and stick to your knitting and focus on the fundamental opportunities because Lord knows there's tons of them.
Yep.
Got anything else?
One last thing, and that is the Supreme Court will start talking about the IEEPA tariffs tomorrow. Now, they may not show their hand whatsoever on what they're thinking on that, and it may not matter at all to markets. But if they do show their hand, that could be a big deal in the market, and I don't think enough people are thinking about it. So just something to keep in the back of our heads.
Yeah, definitely something you want to look out for. All right, guys. Well, you know the deal. You can find us on social media. I'm at KYR Radio. Chase is at Pinecone Macro. You can find video content on YouTube. Just search Know Your Risk Podcast or go to knowyourriskpodcast.com. Download, subscribe. You guys know the deal. We'll see you tomorrow. Until then, you're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC-registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.